everyone, and welcome back to another Conquer FX YouTube video. We're going to start doing a different style of YouTube videos by basically taking a subject or a question that I'm asked, and I can answer it here in more detail and hopefully bring a little bit more clarity to the subject itself, and hopefully provide you, the viewer, with a bit of value to take away. And obviously then become a better trader, see your performance come up, etc., etc. And that's why this channel is here. We're going to be talking about some different hard truths. I'm not here to tell you what you want to hear. I'm telling you what you need to hear. And a lot of my videos, the outlook I have is that it takes a lot of hard work. You're going to be working with statistics, data. It's realistically going to be one of the hardest things you ever do coming into this journey. And I'm definitely not going to sell you a dream, because that is not the reality of it. So let me just fix this light here. Right, so as I was saying, we're going to be talking about the subject on should you let your winners run, okay? And this is going to be, we're going to basically break this down in a bit of clarity here, hopefully give you a whole new perspective on letting your winners run, because the majority of people say, if you watch different trading videos or whatever else, the majority of people are constantly saying you should let your winners run and you should cut your losses short. Okay, it's just like with trading psychology. They always say, you need to focus on patience, or you need to not be greedy, or whatever else. That sounds very well. That always makes people sound very smart and that they know what they're talking about. And in your head, you register it as, that sounds logical. That sounds like the smart thing to do. But in reality, then when you ask them for the blueprint of how to do X, they can't provide it to you because their knowledge only goes so far. So hopefully this YouTube channel could be something that actually provides you with more detail about these different subjects, about these different things, where people will say something to sound smart, and we can actually break it down in detail here, give you different basic methods that will apply to all traders of all styles. So what I will say is, before we jump into this, if you could please like this video, and if you have a question, so like, should you let your winners run, comment that down below. It might be on what's your view on patience, or what's your view on, this particular strategy, or should I manage my trade with X? Whatever it is, ask down below. I will use them for the next YouTube videos coming up, and your question will be answered. And actually, realistically, it's going to actually help me get out more YouTube videos and provide more value, as I'm able to gauge where you guys, what way you want the content to be, and what questions you need answering with, to actually help you directly. But like I was saying, let's just jump straight in here. Should you let your winners run? Okay, this is it really does depend. Okay, because what you need to understand is, yes, you should let your winners run if you have the data, but no, you shouldn't let your winners run if you don't have the data. It doesn't make logical sense to just let your trades run and keep running because you have a feeling that it's going to get to X price level. That does not make sense. That is an emotional trader, and an emotional trader is not consistent. Because if you think about it, if you're trading based off how you feel, and you don't feel the same way as you did today, as you did yesterday, and the day before that, and the day before that, that inconsistency in how you're feeling is going to show up in your actual performance and in your equity curve, and it's basically going to look like a roller coaster. So this brings up the next question. Well, if we are meant to let our winners run, how far do you let it run? And the only way to get that answer is through hard work of collecting the stats itself. So what we need to understand is there's different questions that come up when we start to ask, how far do you let your winners run? Okay, one of these is, we need to be able to keep it fairly consistent. So we need to develop some sort of hypothesis that is fixed but flexible enough that we can use it across different pairs. Let's say if you're trading Forex. So these different metrics need to be consistent, because if we're just saying that, we're going to have a target of 20 pips full stop, that might be different. That might be too short or too big, depending on the pair you're trading, depending on the volatility and everything else. So we need something that is a little bit more flexible, but also quite fixed in its approach as well. And this is going to keep your trading a consistent, repeatable process. And that is what we need here. The more things that change, and ifs and buts and different variants we bring into our trading, the less consistent our approach is going to be. And if our approach is not consistent, our results will not be consistent as well. And we will struggle emotionally, and we'll start to change things and everything else. And this is why one thing that I'm constantly talking about is, if you have a lack of clarity, you're going to have a lack of edge. And that's what we need to understand. So what metrics can you use to keep your approach consistent? Let's just talk about some basic different things here. Let's say if you want to base your decision making on your targets, on how far you want to let your winners run, or whatever else off the ATR. You could have an initial target and basically go through your charts, mark up all the different setups, and let's just say you have to develop some sort of hypothesis. So the ATR is the average true range. It's, you know, used by so many traders for targets, stop losses, you know, to see the average daily range of movement, you know, depending on what pair you're trading. And basically you can use a stop loss of 1 times ATR. So that would be a daily range. So basically if the daily range is 70 pips, 1 ATR would be 70 pips, and you could use a stop loss for that. And then you could say, I'm going to target 3 times the ATR. So 3 times the daily range, which would be, you know, a fixed number, a fixed metric, but it's flexible enough to be tailored depending on the range or volume of that specific pair. So this is where we start keeping things fairly flexible, but also fixed in the way that we're using 1 ATR or 3 ATR for our target, or 2 ATR, 5 ATR, whatever it may be. Obviously, that's depending on the time frame you're trading as well. You want to tailor it for you. So, you know, specifically, I trade a 15-minute chart. So I'm taking my ATR from a 100 length value, and I'm going to be using that on I'm going to be taking my ATR from the 1 hour chart. And then I'm using that ATR on the 15-minute. That's personally how I use it. I usually, you know, use my stop loss as 1 ATR, and I'm targeting 3 times ATR or 2 times ATR, depending on the different variables that are there, which we're going to talk about in this video. So, like I was saying, we want to use something that is consistent, okay? And you can also use something like fixed metrics, okay? Weekly highs and lows. So we can argue about a break-in structure. If you think about this, let's just get this up here and just have a quick talk about it. You know, if we're looking at market structure overall, someone might say that, okay, this is a higher high and higher low, but we might call this a break-in structure, but someone up here on the inside could be looking at the inner structure here and say that the break-in structure was up here, while the other person is saying it's all the way down here. Now, this is why market structure is subjective. When we, you know, take 2 traders and we ask them to even just mark out basic highs and lows or whatever it is, the way they view the market, the way they view the market structure is going to be very, very personal to them. And this is why it makes things very, very subjective. It is not fixed. And we can argue about it back and forth and try to explain our views and try to develop metrics around it, but there's nothing really fixed in the approach about it. But what is fixed is stuff like weekly highs, daily highs, the hourly high and low, the 15-minute, the 30-minute high and low, the yearly high and low, the Monday opening price, today's opening price, today's closing price. All these different things are fixed, and we cannot argue over them. You know, they are just fixed. This is the weekly high. This is the daily high. This is the weekly low. This is the opening price. This is the weekly opening price, the monthly opening price, whatever it may be. I'm just giving this as an example. And these are fixed metrics. So if you're trying to figure out how far do you want to let your trades run, we can use these metrics to actually provide more context around our data. So for example, if you're down at the low of the week and you want to target the high of the week, that is fixed. And you can use these metrics to actually develop a more consistent approach. So you might want to find the probability that if I take a trade down low when it's outside the weekly low, what is, or, you know, maybe the market broke out of the weekly low, came back inside, and then you want to trade it back up to the weekly high on the following day. And you would want to develop the metrics or find the stats around that. So what is the probability of me targeting the, you know, opposite weekly boundary? So if you're trading from the low, what is the probability that if I take a trade down by the low, or if there's a consolidation down low, what is the probability that I'm going to even reach the opposite boundary of the week? So in that case, the weekly high. And that will provide more context and a lot more of a consistent approach when it even comes to your targets alone. You can also use this then, let's just say, for example, if you're targeting a 2-to-1 trade, and you know your target is here and your weekly high is up here, well, you might want to start developing metrics of, well, what is the probability that we will reach that weekly high? And then when you reach your initial target, you can start to base off the probabilities, you know, of, okay, well, if I take majority of profits here, how long can I run these targets until we reach the weekly high? What is the probability of us even reaching there? And if that's around 20-30%, well, it's going to make sense now to close your profits here at your target, and that is not an emotional decision. But let's say if we have a 70%, 80% probability that we are going to reach that opposite weekly boundary, well, now it makes sense to develop more of a consistent approach that when you reach your initial targets, now you're making your decisions not based off of feeling, but actually based off the data alone. So you can basically tailor now that, okay, maybe I want to let my winners run here. Maybe there's a news event and where the market is priced in some data or whatever it is. And maybe there's a change in seasonality if you're, a much more longer term trader, whatever it is. You develop metrics around it to become more consistent. And you can use that then as a metric for how far can I let my trades run under these certain circumstances. The next would be to maybe even use a trailing stop. So like I said here, if you reach your initial target and then you want to, maybe there's a 70% probability that with this specific template will reach the weekly high, you may want to start trailing your stop after your initial target is hit to that point. That will all depend on the volume that's available. So it will also depend on, say, if you're an intraday trader, are you coming into the New York session that is going to fuel that up and give you enough volume that the market is not going to be choppy and stop you out with your trailing stop? So all of these different questions start to come up as we start to ask a basic question of, should we let our winners run? What you also need to understand about letting your winners run is that there is no such thing as a risk-free trade. I hate this. And we hear, if you don't need to even believe me, we hear well-known traders like Trader Dante, for example. A lot of people will know him on Twitter and the stuff he teaches. He will always say, there's no such thing as a risk-free trade. He uses the C word and everything else to describe these idiots who believe they're a risk-free trade. And basically what he's trying to, get home or really drive home here, and his point that he's trying to make is that you should only be moving to break even only if you have a reason to, based off your data. If you are moving to break even because it makes you feel more comfortable, because now you believe you can't lose, trust me, this is not a decision you want to be making. This is not a rabbit hole you want to be bringing yourself down. Because what you're going to find is that eventually when you do discover the world of data and statistics, you might find that you've left a lot of money on the table by simply not asking the question, when should I move to break even, if ever? And that is the thing. You're told on Instagram, risk 1%. You're told to move to break even. You're told X, Y, and Z. And you just take these decisions for face value and you start bringing them into your trading in one of the most competitive environments that there is available. When really you should be questioning everything. Who is he to say that? Who is he that I should be taking that advice from? I should actually take what he says with a pinch of salt and confirm it in the charts with real data and statistical decisions to back it up. So only move to break even if you have a real reason to do so. It might be costing you money to move to break even. I've had plenty of strategies where I've moved to break even. I've checked the data and I've said, shit, I'm leaving so much money on the table over the space of 2-3 years. But the problem is you're moving to break even because you're thinking about the decision now and the weight that this one trade has based on how uncomfortable you feel and everything else. While the professionals are basing decisions off what happens if I move to break even on all of these trades over the next 5 years. Am I making money or am I leaving money on the table? Is it costing me to play the game by moving to break even just because I'm uncomfortable? And if you are uncomfortable, well then put different ways in to help you. Develop more clarity around your trade management of when you should be getting out or should you be holding a trade till take profit or stop loss. And the only way to do that is to actually bring data into the picture. Or from a psychological point of view, just stop looking at your charts, place a trade, forget about it and leave. Know if there's news to come up, okay, maybe you might want to be at the charts there and then, but do not get scared out because you just feel uncomfortable. And what do people say? People will constantly say that greed is bad when this is a performance field. It's like an athlete. Are you going to say that, some of the top Olympic athletes in the world are greedy for wanting more gold medals? No. So why should we be shamed for wanting more money? At the end of the day, that's what, we're not even going to really argue with this. The majority of people here are here for the money. And then you have these idiots telling you that don't think about the money. Well, yeah, no shit. I would do that if it was that easy. But the reality is it's not that easy. You're thinking about the money constantly as you calculate your risk when you see it fluctuate on your P&L. So the only way to throw that to the side is to bring more clarity to what you're doing. And greed doesn't become such a problem anymore when you have metrics to back up your decision making. So in a summary, you have to realize that greed is no longer a problem problem when you've more clarity behind how far you should let that trade run. When should you be getting out of that trade? Under what different variables should you be getting out of that trade earlier? So for example, let's say you want to run your trades on average over, for a target of 3 ATR. Let's just use a basic example here. If you look here, what are the different variables? Well, will you trade the news? Like, for example, what happens during news, depending on the result or whatever else? Will there be more choppiness? Are you more open to getting spiked lower before your trade moves up higher, whatever it is? Choppiness and clearing out on both sides of that range. So maybe you might not trade that day. So that will be a variable where I don't trade because my data shows me X. Or you might say to yourself, well, actually on news days, I've seen that a lot of the time, if something is priced into the market, we have the initial push up, and then just before the news comes out, literally we might be driving up higher to get that necessary liquidity to fuel those orders lower. Or maybe the Fed have given some sort of forward guidance. Maybe you want to get in before the FOMC result comes out, and you can just use the rumor to get a shorter target, for example. So these are all different variables that really only come with experience. The next thing is maybe you might change depending on the market phase. For example, I see people when we look at ICT and things like this with order blocks, people don't realize that there are certain characteristics around this where it works very, very well. It really does work well when you have a clear trending market, where you have a clear trend and aggressive pullbacks. That is the characteristics of trading these order blocks or trading this optimal trade entry. What I think that's what it's called, with the Fibonacci levels, etc. Things like Fibonacci, things like order blocks, they all need aggressive pullbacks into that V bottom. And that means that your strategy is going to perform best when you have a clear trend. So obviously you need a clear way of identifying that trend. But you have to realize that, are you going to now gravitate towards these certain levels, or are you going to let your winners run if you are in a ranging market phase where your system is not going to perform as well? Maybe you have your stop 1 ATR or your target 1 ATR above the nearest high. Well, that might change now if we're in a ranging market, because we may not even come up that high above the initial range boundary. So all of these different things need to be tested. And as you ask one question, different questions are going to come up. Like I said, would you let your winners run? Well, the next question comes up is, well, if the answer is yes, how far do you let it run? And then you need to start diving into all the statistics. And really the most basic way to do this is to actually take your strategy, mark it up on your chart, and start messing around with the different hypotheses that you have. So maybe I want to run it for X amount of pips, or maybe I want to run it for 3 ATR. Maybe I want to run it to the previous weekly high. Maybe I want to hold that trade till the end of the week under these certain market conditions. And if you are interested in any of this stuff, this is literally what we talk about in the Conquer FX mentorship. This is exactly what I teach: statistical price action strategies. There's no emotional decisions. We bring real clarity to your trading. And you can see here an actual detailed breakdown of everything that's included in the course. None of this bullshit of people saying higher highs and higher lows and all of this stuff and making decisions based off some sort of random market structure that is completely subjective. You need things that are fixed in metrics, and then develop statistics around that so you have a consistent, repeatable approach. So, like I was saying, should you let your winners run? The real question is, how far do you let it run if you are going to do so? And the only way to answer that question is to develop or develop a statistical edge, is to gather the statistics behind it. Stop making emotional decisions. Stop basing your targets off, today I feel like this is going to run further because we have X news result or whatever else. Start developing a more consistent approach and treating this like a professional business. If you enjoyed this video, please subscribe, like, and comment below.